Hi everyone, today let's look at the Fundrise Q3 investor letter. Then we'll look at my current account and how I'm contributing money. If you like investing and making money, definitely like and subscribe. I make videos like this every single day that the markets are open as well as Sundays, so make sure you hit the bell so you don't miss out on any future episodes. Welcome to the Portfolio Bulletin. Let's get started. So looking at the investor letter, they start off by saying real estate prices are countercyclical to interest rates, and interest rates have been going pretty high pretty quickly, meaning that real estate is coming down a little bit, and that the cracks are continuing to appear in the economy. Fundrise has been talking about this for a long time, waiting for this downturn. Now it does seem like it's finally coming at least a little bit. In terms of how they've performed versus everything else, Fundrise flagship fund down 6%. Income fund up 10%. That's where I've been putting more of my money more recently. S&P 500 for Q3 was down 8%. And then the Vanguard Real Estate ETF down 30%. And this is returns from 1 January 22 to September of 23. And basically what they're saying is Fundrise has been very resilient, whereas public REITs have suffered the worst. And really, Fundrise income is the place to be, at least over the last year and a half. And that's really what they start to say here. Fundrise has preserved more value than the public market, especially when you're trying to invest in real estate, and even over the S&P 500, which has recovered quite nicely over the last year, but it's still down pretty substantially from the 2022 highs. Of course, you have to account for the fact that public markets constantly price public REITs, whereas Fundrise determines the price based on the underlying assets that each fund owns, as well as the opinions of independent third-party appraisers, as well as comps or comparable homes in the same area. They mention here there is reluctance amongst sellers to sell their homes below market highs, as they have come down a little bit over the past 18 months, leaving a high bid-ask gap in the real estate market. They also talk about interest rates staying higher for longer, even higher than was originally predicted, which is obviously a headwind for real estate values. And of course, Fundrise is facing that along with the public real estate market, which like we talked about before is down 30% from 1 January of 2022. They say, in simplest terms, a 5% return on real estate might be nice when your savings account is generating 0%, but now that savings accounts are generating 5%, real estate inherently has to return more money for it to be appealing, which means the value of that real estate does have to go down a little bit in order to return that premium, which means the real estate values are going to have to go down eventually, even if we haven't seen that from single-family homes quite yet. Then you have to account for the fact that the quote-unquote Magnificent Seven, which is Apple, Amazon, Google, Microsoft, Facebook, Nvidia, and Tesla stocks that we have talked about quite a lot, have returned more than 50% year to date, whereas everything else has returned about 5%. So we have those best stocks in the world generating almost all of the returns, whereas everything else has struggled. And the question is, can they continue to prop up the rest of the market? And it doesn't seem likely, especially if you've looked at the market price here recently. Of course, when you talk about these kind of companies, you do have to reference AI, and they said they are trying to get behind that a little bit here in the Innovation Fund. The question is, how much of AI is hype, and how much of it is a revolutionary new technology that is going to change the future? They say both could be true. It could be hype here in the early stages, but in the longer term, it could be a generational change. They also mentioned that their earlier calls were a little bit too pessimistic on markets. So far, the economy has done quite well in comparison to Fundrise's original thoughts on where the economy would be at this point. And it's clear that the $5 trillion in pandemic stimulus is still supporting markets at least a little bit. And it's worth noting that the government continues to spend on things like infrastructure, green energy, defense, and other things. And many borrowers are still benefiting from the fact that they locked in very low fixed rates in 2022, and they're not moving out of these properties, which is part of what's keeping real estate prices higher. They also mentioned that they could be seeing cracks in the system with the 10-year yield reaching 15-year highs going back to 2007, and we've been talking about this for a while, with mortgage rates nearing 8%, which is going to further cool off the housing market. They say despite all of this, the stock market is still currently trading at a forward multiple 2 times higher than in 2019, which means we are either going to see historical future growth or the market is going to come down. And this kind of goes back to the Magnificent Seven like we talked about. Really, it's just those top 7 companies that are doing well. Everyone else is basically flat in that 5% range or worse. And then they go through their returns, public REITs versus Fundrise versus public stock. Public stock has done well so far year to date. Fundrise still slightly negative, but better than public REITs. In terms of net returns by fund, flagship real estate down 5%. Income continues to do well. Even innovation is positive on the year. Growth, all seeing negative numbers this year. East Coast suffering the most at minus 12%. But you can't forget that flagship is still up 13%, income 4.6%, and the innovation fund 0.5% since inception. Moving over to my accounts, you can see current value up at 66,000. We did dip down in September just a little bit, and then we popped back up here a little bit in value. That's probably just contributions. So far, dividends 3,100 since May of 2019. Net returns $7,500. Again, over the last 4.5 years or so. Looking at net returns, you can see it's still negative for every quarter this year. Net return still up around 6%. And looking at an annual basis, you can see that here. So 2021 was the big year. Last year, still positive, but not great. And then this year, down 4%. In terms of returns by fund, you can see that 5% for this year. Flagship real estate not doing great. Talked about the East Coast REIT being the one that suffered the most. But let's look at these in terms of dollars. You can see that's $600 here. East Coast Fund does not hold very much money for me. So that's only down $350, even though it's the highest in terms of percentage. And then you can look at the other funds here, venture capital being that innovation fund like we talked about, up slightly on the year. And then private capital, this is that income fund where I'm currently contributing the most money. In terms of investing, I'm still putting in $500 every single month here to Fundrise. You can see I got $108 in dividends for this quarter. And in terms of that breakdown here, you can see flagship fund, $125 out of the $500. Income being the largest piece, like we talked about, $300. And then a little bit here into growth at $75. Overall, Fundrise continues to be a major part of my investing portfolio and the majority of my real estate holdings, and I continue to contribute every single month here in order to grow the real estate piece of my investing portfolio. Let me know down in the comment section what you think of Fundrise's take on the current economy, or their thoughts on interest rates, or how they're performing relative to the rest of the markets. Definitely like and subscribe if you got any value out of this video, and make sure you hit the bell so you don't miss out on any future episodes. Of course, none of this is financial advice. This is all for entertainment purposes. Good luck in your trading and have a great day.